today it sounds very similar. No, we saw since the 80s the monetary and fiscal policies have progressively become larger, and so it's a similar in that sense. But today I think policymakers are really clueless about how much is the impact of fiscal spending, for instance, will have on inflation in the following years.
If we do see the pandemic fading away into more of an endemic issue, then where do you see gold and silver heading?
Well, I think gold and silver have been certainly lagging the commodity space as a whole. And I think it's about time for them to be performing relative to commodity space, but also relative to growth stocks. We've had gold and silver miners today relative to growth stocks at very distorted levels on both sides because growth have been extremely overvalued, but also because miners have been extremely undervalued. So that ratio has been a good barometer for risk in the past, and the other parts of the market that we've seen this happen certainly follow to a decline in the overall equity market, but an appreciation of gold and silver miners. This was in the tech bubble where we did see a little bit of an issue with gold and silver stocks, but then immediately follow back with a strong returns in that space. But also we saw this even in 2015 and at the end of 2018 as well, where the markets fell apart back in the last quarter of 2018. So I think we're kind of getting into that setup. I mean, 2021 was a whole repricing of massive monetary loosening to potential risk of tightening. And now this is mostly priced in the precious metal space. And I think, especially when you look at even the change, the rate of change of interest rates in the Fed funds rate, especially, you can see clearly that that may coincide a lot with the beginning of a move in gold prices to the upside. Why that? Well, first of all, the prior decline has to do with how gold usually is always thinking ahead of time. And, we know that the Federal Reserve is trapped at the end of the day, and there's not much of a room for raising interest rates to levels that can really fight inflation. You don't raise interest rates to 2% to fight inflation. You raise interest rates to double digits. But the Federal Reserve is not allowed to do that, given where multiples of equity markets are and the amount of leverage in the system that we all know, especially in the government side. And so it's quite impossible to foresee a scenario where, like we saw in the 70s, where monetary policy was able to follow along with the inflation trends. This time around, it's going to be quite different because it's not going to be capable of following to the same degree of inflation rates moving to the upside. So the gold and silver market have seen probably the worst part of the cycle here have already happened, which it was mostly a consolidation period. Gold still is at 1800s, which is a very profitable level right now for the miners. Silver a little bit lower than you would expect, but the gold to silver ratio being at the levels that it is makes silver look extremely undervalued. So it's all good for precious metals. Those are all good news. And for those investors that are looking at gold being replaced by cryptocurrencies or any other issues like that, are perhaps missing the point of how massively undervalued and even historically oversold a lot of those assets look today.
What I'm hearing is the issue of inflation in your mind is not going to be resolved because the Fed is not going to be aggressive enough. And then this is going to be bullish for metals.
That's exactly right. And if you go back to, it reminds me of going back to the 1960s, late 60s especially, because in the 60s we went through an environment where inflation was running below 2% or so, very suppressed inflation rates. And what made that happen was the complacency of policymaking, where they thought that inflation was never going to come back. So they began to become more and more aggressive. Today, it sounds very similar, no? We saw since the 80s, the monetary and fiscal policies have progressively become larger. And so it's a similar in that sense. But today, I think policymakers are really clueless about how much is the impact of fiscal spending, for instance, will have on inflation in the following years. Just for the fact that we're talking about a massive infrastructure development just to fix supposedly the inflation problem. That is not, if you go back to the 70s and the 60s, late 60s, when inflation was starting to get out of control, policymakers were very well aware that fiscal spending to the levels that we're seeing today would certainly create inflation. But the problem is the fiscal agenda has never been so extended. You have the green revolution happening. You have the peak inequality where there's a major focus into bringing up the bottom 50% and bringing it down the top percentiles of the population today. And financially speaking, you have the fiscal arms race with China. It's a spending arms race where both economies have been basically fighting with strategic parts of the economy where today the fiscal agenda has been very focused on helping parts of the economy here, companies especially in the U.S., that potentially could now compete with China in a global level that is perhaps a little more fair. Things that the Chinese economy have been doing for many years, which is using subsidies to help companies to become more competitive globally. This is the same thing that is happening in the U.S. today. And on top of it, you throw the infrastructure bill that is also going to come in because there's a major push towards that. So all those four things, the peak inequality, the infrastructure developments, on top of the China situation, all of those are going to be come into place into continuing to have a very large twin deficit relative to GDP, which today we're at levels that are 3 percentage points lower than what we saw back in the very worst part of the global financial crisis. So all of that is driving the demand side. Then you have the wages and salaries part, which we haven't seen in many, many decades here. And similar to the 70s, we're seeing a wages and salaries growth spiral beginning, in our opinion. And that is also going to be adding to these inflationary forces. And on top of it, you have the fiscal and monetary disorder. That is not going to be ending anytime soon. So all of those are creating a macro regime shift towards inflation, in my opinion, that are going to be changing the market leadership and the way we think about the macro economy and how we are going to be allocating assets. In my opinion, it's a great time to be putting money into commodities, tangible assets. None of us own enough tangible assets, in my opinion. And that is really what investors should be thinking about relative to those growth stocks that are extreme multiples that I think will be suffering for the following years.